The book Think and Trade Like a Champion by Mark Minervini will help you take control of your trading by following timeless rules and proven techniques. It will give you answers to some of the toughest and most confusing questions, such as when to hold a short-term winner for a long-term gain, when to cut your loss even before your stop is hit, how to establish the optimal position size, how and when to buy and sell, and what to examine during your post-trade analysis to improve your weaknesses and build a solid foundation for success. It's a must-read for everyone serious about trading. At Read and Grow, we believe that books can change your life. Whatever your situation is, someone out there has gone through the same and shared the lessons in a book. Subscribe and join us on our quest to solve problems one book at a time. The stock market is a demanding taskmaster. Make a mistake and you will get penalized, not only financially but emotionally. The market can mug your pocket and beat up your psyche. Coming back from losses in dollars and self-confidence is not easy, but there are ways of protecting yourself which work with any strategy. Mark Minervini offers some foundational rules to follow. 1. Always go in with a plan. Your goal as a stock speculator is preparedness, to trade with few surprises. To do so, you need to develop a dependable way to handle virtually every situation that may occur. Whatever your trading strategy is, if you don't have a plan, you will eventually sabotage yourself. The key elements of a trading plan are an entry mechanism that determines precisely what triggers a buy decision. How are you going to deal with risk? What will you do if the trade moves against you, or if the reason you bought the stock changes suddenly? How are you going to lock in your profits? How will you position size, and when will you decide to reallocate funds? 2. Approach every trade risk first. You can't completely avoid risk, but you can minimize it and have a significant degree of control over it. If you want to mitigate risk effectively, you simply must acknowledge that stocks don't manage themselves. You are the manager, and it's up to you to protect your hard-earned capital. With every trade you make, think and act risk first. That way, you know exactly what you stand to lose if you're wrong, which in trading is far more important than what you stand to gain if you're right, because if you lose all your chips, the game is over. Every huge loss starts as a small one. The only way to protect a trade from turning into a large loss is to accept a small loss before it snowballs out of control. You must avoid rationalization, coming up with reasons and justification for why you should hold on to a losing trade. You should always determine in advance the price at which you set your stop loss. Then write it down, put it on a post-it, and program your computer to send you an alert when that price is reached. Remember to keep your losses to 10% or less because losses work against you geometrically. The further away you get from the 10% mark, the more it takes to get even. 3. Never risk more than you can expect to gain. In order to set an appropriate stop loss, you need to know your average gain. Not just what you hope to make on each individual trade, but a number you can reasonably expect to occur over time on average. To make every trade an intelligent risk-reward decision, use the following formula. PWT, percentage of winning trades, times AG, average gain, over PLT, percentage of losing trades, times AL, average loss, equals expectancy. 4. Know the truth about your trading. By keeping track of your results, you will gain insight into yourself and your trading that no book, seminar, or system could ever tell you. Your results are the fingerprints of everything you do, from the criteria for identifying trades to your ability and consistency in executing them. Keep a trading journal and commit to updating it regularly without fail. Statistics you should track include average win, average loss, win-loss ratio, batting average, percentage of winning trades, adjusted win-loss ratio, adjusted for batting average, largest wins, largest losses, number of days gains are held, number of days losses are held. For your feedback loop to be relevant, it must be employed consistently and regularly. As part of your post-trading analysis, do quarterly and annual evaluations to gather as much information about your trades as possible. 5. Compound money, not mistakes. Only losers average down on losing positions. Holding on to a sharply falling stock, or worse, buying more when the price goes lower, May make you money once, twice, or a few times, but at some point your stocks will keep on falling. You might even compound your mistakes by convincing yourself this has to be the bottom, so you buy even more. Some investors are so egotistical about accepting mistakes that they double down several times. Amateur traders strive to be right. Pros strive to make money. Pros play the percentages, they're consistent, and they avoid the big errors. Never hold a large position going into a major report unless you have a reasonable profit cushion. Regardless of how well you know the company, holding into earning is always a gamble. In the stock market, there is no truth without believers. That's why you should never buy the story and never buy the numbers without price confirmation. With stock trading, the fundamentals and the story are not as important as how institutional investors, the ones that move stock prices significantly, perceive the numbers and the narrative. Stories, earning reports, and valuation do not move stock prices. People do. Without a willing buyer, stocks of even the highest quality companies are just worthless pieces of paper. If the stock's price action is not confirming the fundamentals, stay away. Develop sit-out power and wait patiently for the right set of circumstances before entering a trade. Follow your strategy and the trading rules that keep you from entering premature, ill-timed, and risky trades for no other reason than you just want to be in the market. How and when to buy stocks. 1. Buy stocks that are in long-term uptrends. 2. The stock must be above its own 200-day moving average. 3. There should be a meaningful pickup in volume, a sign of institutional support. Position sizing. If you want to achieve super performance, diversifying your portfolio too much is counterproductive. Your goal instead should be optimal position sizing. The size of your position should be determined by how much equity you stand to lose if a trade goes against you. To dial in the correct amount of risk, you adjust either your stop or your position size. Position sizing guidelines. 1.25 to 2.5% of total equity maximum risk per any one trade. 10% maximum stop. Losses should average no more than 5 to 6%. Never take a position larger than 50%. Shoot for optimal 20 to 25% positions in your top picks. No more than 10 to 12 stocks total. Even when fully invested, don't close your eyes to new opportunities. Constantly evaluate your holdings. If a stock is not appreciating in a timely manner, or it looks like it's coming to the end of its run, it's probably time to reallocate into a more promising candidate. Your money should always be moving to where you are going to reap the best performance and moving out of troubled positions that put your capital at risk. When to sell and nail down profits. One of the most indecisive moments in trading is when to sell. Sell too soon and you fear losing on future profits. Sell too late and you regret giving back your profits. Two emotions, fear and regret, lead to indecisiveness. The only way to control these emotions and keep them from undermining your success is with sound trading rules. As you look at scenarios for selling, consider these rules. 1. The break-even or better rule. You use a trailing stop to protect your profits, moving it in increments with the advancing price and using the 50-day moving average line to determine the level. 2. The free roll rule. Once a stop moves up 2 or 3 times your stop, you can sell half of your position and move your stop on the other half at break-even. You are now free rolling the second half and guaranteeing yourself a profit on the first. 3. The backstop rule. This is the use of a profit protection stop that stops you out of the trade with a gain. You are setting the level based on the amount of profit you want to protect and then allowing the stock to fluctuate above that level. The book offers a lot of very specific setups, rules, buy and sell signals, patterns to look for, as well as plenty of case studies. It covers all the technical aspects of trading, but all your knowledge, practice, and even skills will be rendered ineffective if you don't have the right mindset. It's the mental game that really separates the top performers from everyone else. To learn more on that topic, watch our summary of Mark Minervini's book, Mindset Secrets for Winning.